You know, when you're watching a split screen broadcast, your brain, um, it usually tries to merge those two images into one coherent story.
Yeah, right? Like you're watching a storm on one side and the damage on the other, so you naturally connect them.
Yeah, you just naturally link them.
Hmm.
But today, looking at the live global financial feeds crossing our desk, I mean, it feels like those two screens are broadcasting from completely different planets.
Oh, absolutely.
Because on one side, we have this unimaginable, just historic wealth generation. And on the other, there's this widespread, really deep frustration over the basic cost of living.
It is, well, it's the ultimate economic cognitive dissonance, really.
Yeah.
We're watching markets price in a future that feels, completely detached from the present reality of the average consumer.
And that is what we are unpacking today. Welcome to NovaStream, your 24/7 channel for live global financial updates. And a huge hello to you tuning into our stream right now.
Thanks for being here.
We know you're probably looking at those dynamic sparkline charts flashing red and green on your screen. So our mission today is to cut through all that noise and bring you the absolute highlights of the day.
And we have a massive amount of ground to cover.
We really do. I mean, we are going to look at a trading day defined by a massive geopolitical sigh of relief, a historic $2 trillion space IPO, a very surprising reality check for meme stock strategies.
Oh, and that brutal divergence in the tech sector.
Yes, where AI hardware is just actively eating software's lunch. So let's jump right into the macro picture. The breaking news feed has been lighting up all day with surging indices.
It's been a sea of green.
Really has. The Dow Jones jumped 353 points, or 0.7%, to close at 51,208.20. And the S&P 500 is up 0.5%, and the Nasdaq edged up 0.3%.
Right, and if you look closely at what is leading the Dow, it's financials and industrials.
Okay, so the traditional heavyweights.
Yeah, you have companies like Goldman Sachs, Verizon, JP Morgan Chase, all gaining over 2%. That is a classic risk-on environment.
Meaning investors are feeling safe.
Precisely. They feel safe enough to move their capital out of defensive positions and back into the broader market.
And the catalyst for all of this green on the screen is a major geopolitical development. We saw reports today announced by President Trump of a draft memorandum of understanding for a U.S.-Iran peace deal.
Yeah, and anytime you have a de-escalation of a major conflict, markets are going to react.
But I want to zero in on the commodities impact here because, that is where the real tension has been living for months.
It really has. And the easing of that geopolitical tension had an immediate direct impact on the global oil market.
We saw Brent crude fall pretty hard, right?
Yeah, it fell 3.4% to $87.33 a barrel, which is its lowest level since March 5th.
Wow.
But to really understand why markets are reacting with such profound relief to this draft agreement, you have to look at what has been happening behind the scenes with global energy reserves.
Right, because we've been burning through them.
Yeah. The world has been quietly but rapidly draining its oil stockpiles just to compensate for the disruptions caused by the war.
So just how low are those stockpiles getting? Because the numbers crossing the wire earlier were, they were staggering.
They were. U.S. government stockpiles were actually poised to hit their lowest levels since 1983.
Wait, 1983?
Yeah, 1983.
I mean, think about the scale of the global economy back then compared to today. The population was smaller. Our energy demands were a fraction of what they are now. To have reserves that low in the modern era feels incredibly precarious.
It is a massive vulnerability. I mean, Antoine Haff, he's a former chief oil analyst at the International Energy Agency. He warned that the market was basically running out of shock absorbers.
Shock absorber.
Yeah, and when we talk about shock absorbers, we mean the physical infrastructure, right? The giant steel storage tanks and the underground salt caverns that governments and companies use as a buffer against supply chain chaos.
And that buffer was almost gone.
Almost entirely gone. The market was looking at a scenario where, unless the Strait of Hormuz could fully reopen to allow more oil to flow out of the Persian Gulf, consumers were about to face a massive, crippling spike in energy costs.
Let's try to visualize this. It's like the global economy is a massive freight truck driving through the desert.
Yeah.
We've been running on fumes, using up the extra jerry cans of gas we kept in the trunk.
That's a good way to put it.
And just as the engine is starting to sputter, this draft peace deal appears on the horizon like a gas station. But I do have to push back here for a second.
Go for it.
A draft memorandum is not a finalized treaty. If this deal isn't signed quickly, won't this entire relief rally just completely evaporate?
You hit on the critical vulnerability in today's market rally. The optimism is priced in, but the physical oil is not yet flowing freely.
Right.
If negotiations stall or, if the situation in the Strait of Hormuz remains restricted, those missing shock absorbers will become painfully obvious.
Because we still don't have the backup supply.
Right. The market is essentially pulling forward the economic benefits of a peace deal that hasn't actually crossed the finish line yet.
It's just fascinating that a potential physical treaty over physical oil immediately rescued a completely digital asset class. Because let's pivot to the live crypto markets, because those dynamic sparkline charts on our NovaStream feed are finally pointing up.
They are indeed.
President Trump's announcement effectively pulled crypto out of a brutal week-long slump.
Which is a textbook demonstration of how macroeconomic catalysts influence digital assets. Digital currencies do not exist in a vacuum.
Do you react to the real world?
Absolutely. They respond to the same geopolitical risk-on or risk-off signals as traditional equities do.
Looking at the live numbers, Bitcoin rebounded sharply today. It opened at $63,553, which is up 3.4%, and it's been hovering right near the $63,700 mark.
Good recovery.
Yeah, and Ethereum has also stabilized. It opened at $3,671, up 3.2%, and it's holding steady in that $1,660 to $1,680 range.
What is particularly notable here from a technical analysis standpoint is where Bitcoin found its floor.
The bounce, right?
Yeah, before this news broke, BTC was sliding, but it found a critical support level right at its 200-week simple moving average, which sits around $62,000.
So for the listener who might just watch the daily price action and doesn't get into the weeds, why does a 4-year average matter so much?
Well, it acts as a psychological battle line for institutional investors. The 200-week moving average essentially represents the baseline cost for long-term holders.
Okay, I see.
So when the price dips to that level, the true believers step in to buy, which stops the bleeding. And that technical floor was vital today when you consider the broader institutional pressure the asset is facing right now.
The ETF situation.
Yes, we are currently looking at a 5th consecutive week of outflows from U.S. spot ETFs.
Wow, 5 weeks. And, a spot ETF is essentially a vehicle that allows traditional finance, like your pension funds and wealth managers, to buy Bitcoin exposure without having to manage a digital wallet.
Right, it's the easy access point.
So if we're seeing 5 weeks of outflows, that means Wall Street institutions are actively pressing the sell button and pulling their cash back.
Precisely that. Institutional capital has been stepping back. So for Bitcoin to hold that $62,000 line in the face of those massive ETF outflows shows how powerful that moving average was as a psychological barrier.
But while institutions are pulling cash out of the ETFs, corporations that actually hold Bitcoin on their balance sheets are taking a completely different approach.
Yeah, we saw a really revealing story across the desk today regarding GameStop.
Right. Everyone knows GameStop sits on a massive Bitcoin stash, and they just renewed their covered call options deal with Coinbase.
This is such a fascinating treasury management strategy.
Let's break down the mechanics of a covered call for the listener. GameStop is essentially getting paid cash today in exchange for a promise to sell their Bitcoin if the price hits $80,000 before the contract expires.
That's right.
They're basically just renting out their upside potential.
That is a perfect description. They collect premium income immediately. If Bitcoin stays below $80,000, they keep the cash and the Bitcoin.
And if it goes up?
If it surges past $80,000, they are forced to sell, capping their profit. It's designed to generate reliable yield rather than, betting on decentralized finance going to the moon.
But wait, let's look at the actual math here, because this is the crazy part. GameStop recently posted a massive record quarter with a $389 million net profit.
A huge quarter for them.
Yeah, and you would think this futuristic crypto-forward option strategy was a massive driver of that success.
Yeah.
But you dig into the filings, those crypto options brought in about $5.8 million in fees.
Right.
And the Bitcoin itself only contributed roughly $1 million to the bottom line. So out of a $389 million profit, the Bitcoin strategy is basically a rounding error, isn't it?
The math doesn't lie. The crypto strategy's impact was shockingly minimal. Furthermore, because of how the pledge arrangement is structured with Coinbase, the coins aren't even counted as direct holdings on their balance sheet.
Wait.
Yeah. GameStop reports a claim for repayment of $369.6 million, which is actually $58 million below their original cost basis for those coins.
That is incredible irony. A retail investor looks at GameStop and sees this vanguard of the meme stock era, a titan of Web3 adoption.
Oh, the narrative is huge.
But their actual financial lifeline, the thing driving that $389 million profit, was a pivot back to physical collectibles. We're talking about selling Pokemon cards and Funko Pops.
Yeah, it's wild.
They are keeping the lights on by selling nostalgic cardboard and plastic, while their highly publicized Bitcoin strategy is basically treading water.
It is a stark reality check on how narratives detach from fundamentals. A company's public persona and the actual mechanics of its balance sheet are often two completely different things.
Really?
GameStop's survival right now relies entirely on traditional retail merchandising.
So we have retail phenomena relying on Pokemon cards. But meanwhile, Wall Street is dealing with a true institutional behemoth today, and this was the massive structural driver of Friday's positive market sentiment. We have to talk about the SpaceX IPO.
Oh, this is the kind of market event that defined an entire financial decade, not just a single year.
The numbers are absolutely staggering. Shares opened at $150 and closed at $161.11. That is a 27.9% gain over their initial offering price of $135.
Huge jump.
This single IPO raised $75 billion. It pushed the company's market capitalization over $2 trillion. And for a brief moment today, it mathematically made Elon Musk the world's first trillionaire.
The scale of a $2 trillion valuation is honestly difficult to comprehend, but the most insightful analysis crossing our feed today came from JP Morgan.
What's their take?
They argue that the broader market is severely underestimating how much a mega IPO of this size helps the broader financial ecosystem, specifically the big investment banks.
Because, I mean, it takes an absolute army to take a $2 trillion company public.
It does. You had a syndicate of 23 banks handling this deal. Goldman Sachs led the pack, with JP Morgan acting as a joint bookrunner. JP Morgan estimates that the underwriting fees for this single blockbuster event could hit $1 billion.
$1 billion just in fees. I always go back to the casino analogy in finance.
Let's hear it.
When we talk about these mega IPOs, the big Wall Street banks are the house. Whether the SpaceX stock skyrockets to Mars or plummets back to Earth in the coming months, the house already took its massive guaranteed cut at the door.
They always win.
Right. They price the stock, find the buyers, and collect their $1 billion before the opening bell even rings.
And JP Morgan's analysis points out that the initial fee is just the beginning. They refer to it as the multiplier effect.
Okay, the multiplier effect.
Yeah, when a generational company like SpaceX or soon AI giants like OpenAI or Anthropic goes public, it acts as a magnet for massive amounts of capital.
So walk us through how that multiplier effect actually plays out on the ground.
Sure. When you mint thousands of new millionaires overnight, those employees need wealth management, so they open accounts at Morgan Stanley. Massive institutional funds have to rebalance their portfolios to include the new stock, which drives massive secondary trading volume on the bank's trading desks.
So the banks make money on the back end, too.
All over the place. It stimulates equity sales divisions and brings retail money off the sidelines. And because of this anticipated surge in ecosystem activity, JP Morgan actually issued short-term buy calls for Goldman Sachs and Morgan Stanley ahead of their Q2 earnings.
The wealth generation at the top of this food chain is just astronomical. But this brings us to a really vital question for you, the listener. What happens when that $2 trillion valuation trickles down into the physical, real-world economy?
This is where it gets really tangible.
Right, because we are seeing a hyper-local real estate shock right now in Texas as a direct result.
The paper wealth created for SpaceX employees is totally unprecedented. Current estimates suggest that the post-tax windfall for the workforce is around $120 billion.
Let's put $120 billion into perspective. The total value of all homes in McAllen, Texas, which is near the Starbase launch facility, is roughly $46 billion.
Think about that.
That means SpaceX employees could mathematically buy the entire city's housing stock, every single home, grocery store, and empty lot, and still have $74 billion left over.
It's mind-boggling. They could pool that money and buy roughly 40% of all the real estate in a major city like San Antonio.
Wow.
And we are already seeing the physical manifestation of this wealth in Austin. Near the Bastrop campus, the influx of newly wealthy employees is driving up demand for luxury real estate, pushing prices for bungalows and luxury apartments into the $1.2 million to $1.5 million range.
And this brings us right back to that split-screen reality we talked about at the top of the stream. We have hyper-concentrated tech wealth, literally capable of buying entire cities.
Yeah.
But then you look at the broader U.S. economy, And the working class is deeply struggling to afford basic groceries and mortgage payments.
And that economic frustration is showing up clearly in the macroeconomic sentiment indicators. If you look at the latest polling data from the New York Times regarding President Trump's handling of the economy, the data illustrates a profound shift among white working-class voters.
Let's look at the historical context there, purely by the numbers, because the swing is notable.
Right, just reporting the data here. During his first midterm in 2018, this specific demographic approved of his economic management by margins of 30 percentage points or more.
Okay, a plus 30 margin.
Today, according to the Times survey, his approval on the cost of living among blue-collar white voters sits at just 36%. Recent polls show a massive swing toward disapproval by margins of 14 to over 30 points.
As someone who watches these macro trends every day, how can the broader financial system sustain this? You have unprecedented wealth generation in these isolated aerospace and tech hubs, while the broader consumer base, the people who actually drive the majority of U.S. GDP through their spending, are expressing severe frustration over basic expenses.
Historically, severe divergences between asset prices and consumer sentiment lead to volatility. When the cost of housing, food, and energy outpaces wage growth, consumer spending eventually contracts.
And that hits the bottom line.
Exactly. Since consumer spending is the engine of the economy, a contraction there bleeds directly into corporate earnings. The stock market can ignore those underlying structural issues while the momentum is strong. But eventually, those two realities have to reconcile.
And what's fascinating is that this tale of two economies, the thriving few and the struggling many, mirrors a brutal civil war happening within the tech sector itself right now. We are watching a clear divide between AI hardware and traditional software.
The market is aggressively picking winners and losers in the age of artificial intelligence. And right now, the hardware manufacturers are undeniably winning. Look at AMD.
Yeah, the chip maker.
Wall Street historically viewed them as a traditional CPU stock, kind of playing second fiddle to Intel. But they are exploding in the GPU market, taking the fight directly to NVIDIA.
And for anyone wondering why GPUs matter so much more than CPUs right now, it basically comes down to architecture.
Right.
A CPU is like a brilliant math professor who can solve one incredibly complex equation at a time, but a GPU is like 1,000 high school students doing simple math simultaneously.
That's a great analogy.
Training an AI model requires millions of simple calculations at once, which makes GPUs the absolute lifeblood of this new era. And AMD's pipeline reflects that shift.
Their momentum is incredible right now. They just secured a massive multi-year deal with Meta that involves 6 gigawatts of data center deployments.
I want to pause on that number, 6 gigawatts.
That's massive.
A single gigawatt is roughly enough to power 750,000 homes. AMD and Meta are deploying the power equivalent of a small nation's energy grid entirely dedicated to running custom MI450 AI chips.
It's hard to wrap your head around.
And they're also shipping their first rack-scale AI system called Helios to major players like OpenAI.
The institutional confidence in AMD is surging as a result. Citi just raised their price target on the stock to $575, which reflects a staggering $833 billion market cap.
Wow.
They are no longer just an alternative. They are a critical pillar of global AI infrastructure.
So the hardware side is booming, but then you look at the software side, and the contrast is genuinely shocking. Let's look at Adobe.
Oh, Adobe.
By all traditional metrics, they just had a phenomenal quarter. Second quarter revenue came in at $6.62 billion, beating estimates of $6.45 billion. Their earnings per share was $5.96, beating the $5.82 expectation.
Great numbers.
Right. But despite those upbeat numbers, Adobe's stock is plummeting. It has dropped 37.5% so far in 2026, hitting its lowest price since January 2019.
It defies traditional market logic. I mean, a company beats earnings and raises guidance, yet the stock experiences a massive sell-off. The underlying issue is that investors are not looking at today's balance sheet.
They're looking ahead.
Right. They are pricing in a terrifying future.
And the internal turmoil at Adobe is certainly not helping alleviate those fears. We saw dramatic details cross the feed today. Adobe's chief financial officer, Dan Durn, is abruptly leaving for Marvell after 5 years.
The timing is tough.
This comes just 3 months after CEO Shantanu Narayan announced he is stepping down after 18 years at the helm. Interim CFO Steve Day is taking over the finances. But the leadership drain is really just a symptom of a much larger existential crisis.
It is. Investors are gripped by a fundamental skepticism regarding the defensibility of software as a service in the AI era. There's a very real fear that generative artificial intelligence will render traditional design software completely unviable.
Unviable, just obsolete.
Think about it. If an AI can generate a perfect image, a complex vector graphic, or a fully edited video from a simple text prompt, the complex, expensive software suites that human designers have relied on for decades suddenly look obsolete. The market isn't looking at Adobe's Q2 earnings. They are looking at a future where Adobe's core product might not even need to exist.
It's like Adobe spent 20 years building the world's absolute best flight simulator. It's complex, it's expensive, and it's industry standard. But AMD and OpenAI just showed up selling actual teleporters.
Oh, I like that.
The market doesn't care how good your flight simulator is if the fundamental rules of travel just changed.
Right.
Why buy the canvas and the brushes when AMD's chips can just print the finished painting?
That analogy perfectly captures the panic. The perceived value in the tech sector is migrating away from the application layer and concentrating entirely in the infrastructure layer. The picks and shovels are what people want.
So what does this all mean for you tuning into NovaStream today? We have covered a massive amount of ground. We saw how the mere draft of a geopolitical agreement can pull global oil prices down and simultaneously pull crypto out of a slump.
A lot of interconnected pieces today.
Yeah. We saw how a historic $2 trillion space IPO makes waves not just on Wall Street trading desks, but in the physical real estate markets of Texas. And we watched the tech sector aggressively sort itself, rewarding the hardware companies building the future while punishing the software giants that might be replaced by it.
And as we watch companies like Adobe struggle to justify their long-term existence despite strong current earnings, well, it leaves us with a profound question to ponder.
What's that?
Will the seemingly invincible software giants of the 2010s become the obsolete dinosaurs of the 2020s? Parallel to that, as the wealth continues to concentrate in hardware and aerospace, how will these new titans physically reshape the communities, the housing markets, and the economies we all share?
Those are the questions that will define the next decade of investing. Just like that split screen broadcast we talked about at the beginning.
Right back to the start.
One screen shows the AI servers spinning up and rockets launching, generating trillions in concentrated wealth. The other screen shows the average person trying to afford groceries and a mortgage. Eventually, those two screens have to merge into one reality. We want to say a warm goodbye to you and thank you for trusting us to bring you the highlights of the day.
Thanks for listening.
Keep watching those tickers, stay informed, stay curious, and we will catch you on the next round of global updates here on NovaStream.